before this, in case anybody's not able to be here tonight, I just wanted to start off tonight. I don't know how much background noise there is. I'm on a pretty unidirectional mic, so hopefully you can all hear. I just wanted to start off. I'm going to share my screen. A couple things I've had questions about. The first one is there's still some, I think, confusion about what work is required for the course, because there's a whole bunch of these additional, or what are they called, little study sets that aren't required. And so when people log in and go straight into McGraw-Hill, they'll see these other assignments that have like weird due dates, like way in April, and it like really throws everybody off. And those are optional; they're not required. And so I just want to show you, like when you look at the modules, only the stuff in the modules is required. Only it counts for your grade. Okay, the additional stuff does not. So like for week 4, it's all of these items, and these are actually the items I also highlight in that weekly email I send out to you. But I wanted to clarify that because some people have asked questions about those additional things that have the weird due dates, and again, those are optional to give you extra practice, but not required. So that's the first thing. The other thing is I know everybody's figured out here this Brother Fox's helpful stuff link, that there's a link to presenter information if you ever forget which week you're supposed to present. And then there's also this link to additional study content. And when you open up that additional study content, I had someone this week asking me, can you work out one of these problems? And it was actually already in here. So like for chapter 2, there's 3 different problems on the quiz access that I already worked out. Those were the 3 that people asked about most last semester. If there's something that's not on there, I can try to do one for you, but it is dependent on, I don't always have time. But the other thing that people don't have missed so far is that there's an exam review in here. And if you click on that exam review, it's actually a PDF, and it actually covers all the exams. And it just breaks down bullet points of the things to study for the exam. I'll let you know that I didn't make this exam review. It was one of the accounting faculty there on campus at BYU Idaho. But I know for a fact that what he did is he just went and looked through each question of the exam and then wrote out a bullet point for the topic it covers. So it's a very good resource. And I know last semester, a lot of the people who were doing well in the class really swore by it. So I just want to make sure everybody knows it's there. Maybe you already knew it was, but I wanted to make sure you knew it was there. Again, you can find that just in the modules, right above all of the weekly modules. There is again, I just called it Brother Fox's helpful stuff, and it's in the Accounting 201 additional study content. So just want to make sure everybody knows that's there. Okay, so that's kind of the general announcements I have. And so I know that we're kind of in a split week here where you're working on chapter 2 stuff, and then we switch over to chapter 11 stuff on Wednesday. So after the stuff's due on Wednesday. So I wanted to start and just see if anybody had maybe specific questions about chapter 2, the quiz access or the quiz that's due coming up here. Any problems you needed me to work out or to look at? Looks like I got the smart kids in the class. Oh wait,
Brother
here
Fox,
comes someone.
I just had, there was one thing when I was taking the chapter 2 quiz, not the access quiz, but the actual quiz. There was one part, like there's a question where it goes through and it says, is this account so decreased with which type of entry? And like it goes through and it has liability accounts and, asset accounts and different things. And you have to put either a debit or a credit that decreases it. And expenses, because expenses and dividends act opposite from regular equity, right? So they're increased with debits and decreased with credits.
Right.
But then on another question, you have to go through and it's like, here's the transaction or here's the event.
Yeah.
And you have to put in, it's this account and it's increasing by this much. And then this account is increasing or decreasing. And with that, it was saying that the expense, because you have to have a debit and a credit to balance, right? So we were decreasing cash because we were paying an expense, but it also had us put in, for it to be right, the expense was also decreasing. So I'm just confused as to how they're deciding which.
Yeah, well, the
what
good
we're
news
doing.
is this won't be an issue after this chapter.
Okay.
So there's this confusing thing when you first start teaching it, because revenue accounts and expense accounts and dividend accounts are not equity accounts. Okay, they're their
Right.
own type of account, but
That
they
then
have
are closed out to retained earnings.
right. And because if they were equity accounts, we wouldn't have to close them out, right? They would be equities. But the fact that they're temporary and will have to be closed tells us that they're not equity accounts.
Mhm.
And so, but they have the effect of reducing retained earnings. And so
Okay.
in the one question, it's asking you what's happening to the account. So when you debit an expense, it's increasing the account. And then the other one, they're asking you what is the effect to
actual
equity, and
Okay.
it's not clear. But in the future, we won't even think of it in this terms. We'll just be debits and credits, and we'll know that expenses and dividends are increased with a debit and decreased with a credit.
Okay.
So and anyway, so I don't have a great answer other than to say it's just a confusing thing when you have some, because and especially if you have students who've done accounting before, because they're kind of starting you back before the debits and credits, focusing on what happens to the accounting equation, but you're still like, wait, which do they want from me?
Yeah.
So
Okay.
I don't know if that helps.
Makes sense. Yeah, no, that makes sense. Thank you.
I should be a politician. That was like a non-answer answer, maybe. Okay. I'm in the wrong calling here. Okay, so yes, Marta.
Can I ask one question along that lines? I think it was 2 weeks ago in the quiz, and I was busy last week and couldn't get in and ask. But on the quiz, one of them, it said, if it's in the same account, put a plus and a minus. And I missed it because both times I'm like, well, this is going to be a minus in the same account, but it's also going to be an add in that account. I think it's the same thing you were just talking about, that you're going to credit this account, but you're going to debit at this account, but it's both going to be in the expense account. Is that going to be a problem going forward? Or I tried to enter it as a plus and a minus in the instructions. It said if it's in the same account, put a plus and a minus, and I tried it one way and then I went back in and did it another way and still missed it. I don't know how I could have gotten that right.
Right, and I'd have to be looking at it to give you a good answer. But and I will tell you, in real life, you almost never credit expense accounts except when you close them. Like the expenses increase and then you close them out to zero at the end of the period. I mean, so the only time you actually credit expense is if you had an error and you're correcting it. Just so that's what I'm saying is we're almost sometimes like when we're first learning something, it's like actually harder than it is in real life because you're trying to figure out what do they want from me rather than what's the correct answer, and that's a problem a lot with these software programs is you're like, just tell me what you want from me, McGraw-Hill, and I'll give it to you. But in the meantime, I'm trying to figure out. So if you want, Marta, if you want me to take a look at that one specifically, I can do that maybe, later on and then email you about it.
I just wondered with the McGraw-Hill book, if we're going to be asked to enter it as a positive or a negative. It sounds like what Katie was asking into the similar kind of account. I don't understand how McGraw-Hill wants it. And I know there's some details about don't put in commas or don't put in the dollar signs, don't put in and so I'm trying to be careful, but I felt like it was a McGraw-Hill specific problem that I wasn't understanding how they wanted it.
Yeah, so send me an email with the if you can see which one is the specific problem, and I'll look it up and I'll answer that.
Okay.
Maybe in fact, I'll answer it for everybody by putting it as a comment when I post this video.
Okay, thank you.
Thanks.
I have a question as well.
Yeah.
Can you please explain a little bit more the difference between balance sheet and trial balance? Because for me, it look like the same.
Yeah, so a trial balance just has the balances of all of the accounts, all of our accounts. So that includes assets, liabilities, equity, and revenue, expenses, and dividends. a balance sheet won't have revenue or expenses on it. It will just have assets, liabilities, and equity. And so the balance sheet is actually meant to tell us the balances of our permanent accounts, which are our assets, liability, and equity accounts. The trial balance is a tool that accountants use to prepare the financial statements. I'll tell you anymore, we don't, because we just hit create financial statements in our software and it does it for us. But still, you have to be able to understand one. So that's the difference, is a trial balance will have all of the accounts, but the balance sheet will only have assets, liabilities, and equity accounts.
What am I?
Thank you.
Question.
Okay, Marta?
Can I just say I'm so grateful we don't have to use a typewriter to do that anymore. I remember the old days when we really did have to credit and debit on the trial balance, and it was a pain, and so we're spoiled.
Yeah, or a ledger book, and you had a reference page for each. So yeah, I'm grateful. When I first started teaching it, we had to grade it by hand too, and so it would take you a week to get feedback back to students. And as much as people don't like McGraw-Hill, it does give immediate feedback and a chance to try again, which is useful. All right. I don't know if you heard that. We just scored a goal.
I have a question.
Yeah.
It's a little bit confusing for me to find how can I can balance my equation on the quiz. It's specifically the number 8, because when I see they give us a common stock, and then I have the cash, and then in the part of the equity, I put it as a common stock, and I think it's supposed to increase the equity, but when I put it in the quiz, it seems like it seems bad. Like they put a red cross on it. Like I don't know. I don't really know how to do it.
Okay. So is it this problem right here?
Number 8.
Yeah, this is number 8 on the quiz. Is this the one that you were?
Let me see. No, that's not the number 8. That's not the number 8.
I wonder if he needs the quiz access, number 8 on the quiz access, and not the actual quiz.
And the actual quiz.
You know,
Quiz access.
The quiz access. I'm sorry, you guys, that I'm out here. If I've seen, this is my son's a senior, and he is very sensitive about us being at all of his last things, and so I'm present even if I'm not really present. That's that's the trick I learned while I was bishop. Like, if you could show up at the last 5 minutes of their choir concert and be like, I saw you, you were great, then you weren't a horrible dad. You're just partially horrible, because you really do want to be there. I just got released a couple weeks ago, and I was sitting with my family last week, and it occurred to me I was sitting next to my 16-year-old, and I hadn't sat next to him in church since he was 4. And so it was a big change to sit there with them and have that moment. Anyway, so it was nice. Anyway, all right. So this one, Gandhi.
Yeah.
Right. And then which specific one was it?
You know, when you have the cash, you have like they say Madison Aries, the owner, invests $5,250 cash, and 22,575 photography equipment in the company exchange for common stock. That means we have cash, we increase in cash, and we increase in equipment too, right? So that's supposed to when I put like a common stock for my equity, and then I say it increase in equity. Oh, I just put I just detail like common stock, and then I put also equipment, and the other part of cash that is increased, and also I put I put the other thing that they say about the
Right.
like they yeah. So
So
when I
yeah,
put,
so go ahead. Sorry, I didn't mean to interrupt you. So yeah, so anyway, so what's happening is the owners are contributing assets, right? They're contributing two different types of assets, cash and equipment. And so all of that will increase the common stock. So in this example I have up on the screen, it was 10,500 in cash and another 45,150 in equipment. And so then our increase to common stock would be the sum of the two. So 55,650. So I don't know what you did without looking at it, but a common error is to just put the amount of cash contributed here as the common stock increase, not
yeah,
realizing, yeah.
that's what I did. Like I put the amount of cash in the part of asset, and I come to the equity part and I say the common stock is increasing. I put the number of cash like $5,000, and then yeah, I just to put them like one part I put on the asset part I put this, and the equity part I put this, and then I didn't find it. I didn't find the answer.
Okay, well, did that help what we just talked about?
Yeah,
Okay,
yeah.
good. So I saw Rachel asked in the chat, is the exam like the quizzes, entering info, or is it multiple choice? And the answer is it's both. It's so there are some multiple choice questions and there are some, you know, entering answer questions.
Are the questions then like they have a lot of little points that accumulate to the whole point amount? Does that make sense?
Yeah, no, it's much more like a fill in the blank type of question, you know, like a so not typically with a whole bunch of little points, more like it would give you like a problem and then say what is the, you know, what is the stockholders equity number, you know, so you're not having to put in all of them, you just having to figure out.
Gotcha. Thanks.
All right, so is everybody ready for me to maybe take a look at a couple of the concepts from chapter 11, or are there still chapter 2 questions? All right, well, let me pull up, just put together a little slideshow. When I say put together, I stole the slides from the textbook publisher, but then like they had like 90 of them, and so I cut it down to like a manageable number, because nobody wants to watch 90 slides. Well, maybe you guys do, but I'm guessing nobody wants to watch 90 slides.
I got another questions for the quiz number 9, because I was trying to set apart each account and then try to find how can I balance the equation so that I can find how much is on the liability and equity part, so that I can subtract it to find out the amount left, so that I can find the equipment numbers, but I cannot find it. I just detailed try to try to make it understandable for me, but I cannot find the result.
Okay, which question was that?
Quiz number 9.
Number 9. Okay, let me see if I can get back to that. All right, so they're asking us to prepare a trial balance, and then they're leaving off equipment, right? So yeah, the trick behind this is we know that our assets have to equal our liabilities plus our equity,
Exactly.
because that's the basic accounting, you know, equation, right? So what we have to do is, for me, because I forget things easy, I start by like labeling each one of these. So I say cash is an asset, account payable is a liability, revenue is a revenue, expense is an expense, equipment's an asset,
Dividend is dividend.
and so forth. So I would label each one, and then I'd create my trial balance, and I would sort of have this trial balance all laid out, with the exception of I wouldn't have equipment yet because I wouldn't have known it yet. And so then I would be able to add up this side and see that it adds up to 5,290, and this side would add up to some amount less than 52,900.
Yeah.
And then, you know, I could just subtract the smaller side from the larger side, and that would be the amount of the equipment that was missing.
Mm-hmm. Yeah, that's what I tried to do, but I didn't think that I supposed to do the B part before doing the other part. Like, I was trying to say, okay, cash is asset, account receivable is asset. So I just labeled them, but I cannot find the numbers. I tried to
Okay.
balance the equation, but the number that I find
Yeah,
didn't
so
match.
without being able to look at yours specifically, you know, it's very easy to accidentally put one on the wrong side or something, you know, so I'd have to pull yours up and look at it. So I could do that again tonight after class and maybe send you a response.
Okay.
Would that be okay?
Yes, problem.
Okay, so I've just given myself 2 assignments, which means I better make a couple notes here or I'll forget. So.
Thank you, Brad. Thank you.
No problem.
I will look at it.
So I'm just going to type this down. This is quiz access number 9. And then the other thing I said I was going to do was I was going to look at, what was it, Marta? It was the, one of the problems from.
I'll send you an email with it in a little while.
Okay, thanks. I was like, I don't remember
like you are.
Okay, all right. So let's take a look at chapter 11. So chapter 11 is about stock. And we know that our equity is made up of 2 things, which one is money that we contribute to the business, and that's called our common stock, or sometimes they call it capital stock. And then it's also made up of retained earnings, which is the money the business earns through doing business. And so this chapter is all about capital stock. So there's a couple concepts that are important to understand. The first is just a terminology that you'll see. One's called the par value of a stock, and that is not the same thing as the market price of the stock. So the par value is this weird value that many states require corporations to put on their corporate charters. And you'll see like $1 or something like that, and it doesn't mean anything. It's arbitrary, like it says here on the slide. But because it's on the corporate charter, then the businesses are required to list it when they do it. And so I'll show you an example of that. The market price of the stock is the amount that somebody could sell the stock for today at the stock market. So those are 2 different things. And then the classes of stock we deal with. Some states, so recognize that corporations are created by state laws. Some states require companies to create par value stock, which has this arbitrary value assigned to it. Other states have something that's called no par value stock, or just no par stock, which means they're not required to put the value on their stock. The third is what's called a stated value stock, which is kind of exactly like par value, but instead of calling it par value, they call it stated value. So I will tell you, if you have questions about what I'm talking about, don't be afraid to interrupt me. It's hard for me to always keep track of the chat window. So just break in and ask the question, and I won't judge you or think you're being rude. Anyway, so these are just terms that we need to know before we understand, or before we start kind of understanding stock.
Could you repeat the meaning again?
Of par value?
Yeah.
Okay. So par value, just it's a difficult concept to understand. So that is, par value is just a value that is assigned to stock when it is created, when the company is actually created. It has no real relevance or bearing on the actual value of the stock. And so it's just this arbitrary number that's just made up on the corporate charter. And again, I'll show you some examples of it here that might help. All right, so again, we know that stock represents money paid in by the owners. And so what we'll see on our balance sheets in a corporation is that we have common stock, which is the amount of money at the par value of the stock that the owners paid in. And then we'll see the paid in capital in excess of par, which is any money that people who bought the stock paid over and above the par value. So again, this is confusing until we see some examples. So right now, I just want you to familiarize you with the term, and then I'll show you some examples. All right, so here's an example of a company who issues stock at its par value. So on June 5th, Dylan Snowboards issues $30,000 share, or 30,000 shares of $10 par value stock for $300,000. So to record that transaction, we would just debit cash because our cash is increasing, and credit the common stock $10 par value. Because the stock was issued at par value, there's no additional entry necessary. We just go ahead and record it because we issued it at par value. But sometimes, most of the time actually, stock is issued at a premium to its par value, meaning that when we issue the stock, the market price is higher than our par value. So we've got to record that we got more than what the par value was. So here on June 5th, Dylan Snowboards issues 30,000 shares of $10 par value stock for $12 per share. So if we issue 30,000 shares for $12 per share, that means we're going to get $360,000 in cash. So we'll debit cash $360,000. But then we're going to record the common stock at the par value. Remember, the par value is $10, so 30,000 shares times $10, $300,000 common stock at par value. And then any amount we received over that par value, we're going to list as paid in capital in excess of par value, $60,000. Recognize that none of these entries, it doesn't change anything other than we're required by the laws of the states where the corporation exists to list the par value of our stock and then any money we receive above that when we issue the stock. It's a little frustrating because there's almost no need for it in the modern accounting world, but still there on state laws. Our balance sheet will kind of end up looking like this. So this is the equity section of our balance sheet. You can see the common stock, $10 par value, has a balance of 300,000. The paid in capital in excess of par has a balance of 60,000, and then our retained earnings is listed. So that'd be our total stockholders' equity, 425,000.
What are some of the reasons for paid in capital?
Oh, I'm sorry. That was really quiet, Brad. I couldn't.
What are some of the reasons for paying extra or adding more money
Beyond the par value?
Right.
Yeah. So what happens is that businesses write up their corporate charter, but a lot of times they don't issue stock right away. So like, for example, my business, I never sold stock to the public, right? I funded it myself. And so I didn't need to ever record the issuance of stock. And it's likely that by the time you are going to grow and issue stock, that the market value per share of your stock, what people are willing to pay for it, is higher than that arbitrary amount you had to you were required by the law to name at the time you created the company. And so that's why people will end up paying in more, because if I'm the company and I'm trying to raise money and my par value is $10, but the market will bear 12, meaning people will pay $12 to buy my stock, of course I'm going to issue it at that higher amount so that I can raise as much capital as possible. Does that help?
Well, and I think too, if we remember the concept that financial accounting is all based on historical numbers, like we don't say, well, this is what my land is worth now. It's just what it was paid for. Like,
Correct.
and so when the stock was created, it was worth $10 or whatever the par value is. But then when it actually sells, it sells for more. So you
Right.
realize what it was created at and then how much more you make on it when you actually sell it and issue it.
Right.
So is
And
it kind of like pre-buying stock at a lower price? Is that kind of a good way to think of it?
kind of, except that what's kind of crazy about it is that par value has zero bearing on worth or value. It's honestly just a number that people put on. Usually they just put $1. Like almost like most companies, you'll see their par value will be $1, and it's not. There's just no basis in value in that number. So what happens is states require a par value on the corporate charter, and so businesses they just put a number on there. And that's what I mean by arbitrary. It doesn't have any basis. And so it's just some number you have to say, this is the par value of a share of stock. I know that doesn't help. Or it doesn't make it easy to understand, because arbitrary things are never easy to understand, I guess. There's no real reason for it. Just recognize that shares of stock have a par value, and that we have to account for the issuance of that stock at its par value, plus any amount that's paid in over that. In a book problem, they always have to tell you the amount of the par value, because you wouldn't know it otherwise. So there's not like some secret there. It'll give that information to you. Sometimes, and like kind of the example we just looked at with Gandhi a minute ago, we issue stock for non-cash assets. So maybe the business needs furniture and business doesn't have a lot of cash, and we go to the furniture store owner and say, hey, we'll give you this many shares of our business's stock in exchange for furniture, or something like that. So here's their example. On June 10th, 4,000 shares of $20 par value stock is given for land valued at $105,000. So what we would do is debit the asset land to increase the value, or not the value, but to record the cost of the land, okay? And then we'll record the value of the common stock we gave at its par value. 4,000 shares at $20 par value is $80,000. And then any amount over and above that, so in this case, the land was worth 105,000, we're going to record as paid in capital in excess of the par value. All right, so if any of you have ever invested in stock, you know, I like dividends day when I'm getting my dividends. All a dividend is a share of the business's profits being paid out to the stockholders. So, I mean, the whole reason I own a business is to try to make money with the business. And so I like those dividends because that's a share of the profits. So businesses can pay a cash dividend, which is paying out cash to the stockholders. Like this says, in order to do that, they have to have enough balance in their retained earnings, and they have to have the cash available to actually do it. So that's what a cash dividend is. Also, sometimes businesses will pay a stock dividend. And a stock dividend is if a business wants to pay shareholders, reward them for investing in the business, but doesn't have cash, what it can do is give additional shares of stock to the shareholders. Does somebody have a question? Okay, I thought I heard someone. And so typically there's two different types of stock dividends. One we call a small stock dividend. That's if we're giving out less than or equal to 25% of the previously outstanding shares, because we're actually issuing new shares. And then a large stock dividend would be if we're paying out more than 25% of our previously outstanding shares. And so when we do a stock dividend, we usually decide the number of shares we're going to pay out and then distribute those to the existing shareholders according to their percentage of ownership. So if you owned 1% of the company, you get 1% of the shares that we're issuing in the stock dividend. If you had owned 10% of the company, then you'd get 10% of the shares we're issuing. That way it's fair. Everybody gets shares according to their share of ownership. So one more concept that is a stock split. A stock split is where we're not issuing any new shares of stock, but what we're doing is we are actually we're reducing the par value of the stock and then doubling the number of shares outstanding. We do this a lot of times just to keep the stock price at a certain target price. We found that a lot of investors are uncomfortable buying stock when the price is too high. So by splitting the stock, what we're doing is, so in this case, this is called a 2-for-1 split. They reduce the par value by half and then double the number of shares. So if a person owned 100 shares of the stock that was at $100 a share, now they would have 200 shares at $50 a share, which means they have the same amount of money, same amount of value in their stock, but more shares. And then as the stock grows, it'll grow with it. So I know that we're covering a lot of what I call sort of more complex points of accounting in this chapter. I will say, like in my classes I teach here in Arizona, I don't cover this till later in the course, but it's not too bad because they go light on it. They don't hit it real hard in this chapter. So here's just sort of a summary of what happens. So if we pay a cash dividend, what we're doing is paying out cash, and we're paying that out of our retained earnings. So when that happens, our assets will decrease because cash is an asset, and our retained earnings will decrease. And since retained earnings is part of stockholders' equity, then our total stockholders' equity will also decrease. When there's a small stock dividend, what we're doing there is we're issuing shares of stock out of our retained earnings. So in essence, what we're doing is buying shares of stock with retained earnings and then distributing those to the shareholders. So in that case, our common stock account will increase and our paid in capital in excess of par will increase and our retained earnings will decrease. On a large stock dividend, they handle it a little bit differently.
Mike,
Yes.
I think you're going too fast because I don't really understand that part.
Okay. Well, and part of the reason I'm going fast is because we have a limited amount of time in these meetings. I will tell you that I'll post the recording so you can watch it more. And I'm also willing to answer questions if you have them now. But I know sometimes when it's so fast, it's hard to even formulate a question. But it's often hard to formulate the question until you've kind of got into the problems and you're actually working on them. So I will try to slow down, but I don't know. I don't know if it's going to help too much because it's just such a new concept. But I'll try here. So on a large stock dividend, what we're doing is we're paying for the common stock out of retained earnings, and we always pay for it. We always record that at the par value, no excess of par. And finally, on a stock split, there'll be no change to any of the accounts. All right, so I apologize for going so fast there. Any questions I can try to answer from the things I just covered?
I think they have plenty of boys, dude.
What was that?
Marta, I think you need to mute your mic.
All right, one more concept, and that's the concept of preferred stock. And preferred stock is a special kind of stock that goes to usually kind of internal shareholders, people like members of the board or you know, the CEO, but not usually sold to the public. And so preferred stock usually has a higher par value and pays a set amount of dividend. And so it looks very similar. Again, when we do the entry, when we issue preferred stock, our cash will increase. And then our preferred stock account and paid in capital in excess of par accounts will also increase. So here, Dylan issues 50 shares, $100 par value preferred stock for $6,000 cash. We'd show our cash increasing with a debit of $6,000 and our preferred stock increasing with a credit of $5,000. And then our paid in capital in excess of par will increase with a credit of $1,000. So these look the same as other stock transactions. Just know preferred stock is different in that it a lot less of it is issued and it pays, like I said, a set dividend amount, whereas with other dividends, with common stock, there's no guarantee of dividends. So the reason companies like to, and also preferred stock doesn't get any voting rights when they're choosing like a new board of directors and things like that. So issuing preferred stock is used often to raise money for the business, but without giving up voting control of the business. Preferred stock comes in two types, and this is based on their dividends. So some preferred stock has what's called cumulative dividends, and the other has what are called non-cumulative dividends. What cumulative dividends means is that if the business is unable to pay a dividend in a given year, then in the next year, before they can pay any dividends to their common shareholders, they have to pay off the dividends that were not paid in the previous year. So cumulative dividends means kind of like guaranteed dividends for the preferred shareholders, whereas with non-cumulative dividends, it means there's no guarantee. And so if it doesn't pay dividends one year, then the shareholders just don't get a dividend, and the next year they'll have to see if they can get one. Does that, any questions about cumulative versus non-cumulative?
Who sets that for the stock? Is that just the company?
Yeah. So again, in their corporate charter, when they sort of draw up the rules of how the corporation will run, if they'll decide if stock is cumulative, if their preferred stock would be cumulative or non-cumulative. And then sorry, I said one last when I said preferred, but treasury stock is one more concept, which is oftentimes, if you remember, businesses issue stock in order to raise funds, right? It's a way you sell off a portion of your business so that you can get extra cash to expand the business or do other things. And so a lot of times when a business starts to grow or get stronger, they'll buy back some of their stock from the market. And when they buy it back, it becomes something called treasury stock, which is just stock that is held by the business itself rather than by just individual shareholders. So that's what treasury stock is. You'll see earnings per share in this chapter. And so I just wanted to show you how to calculate earnings per share. Earnings per share is what it sounds like. It's the profits or net income that a business makes divided by its average number of shares outstanding. And so to calculate it, we take the net income minus any preferred dividends, and then we divide that by the weighted average common shares outstanding. All that means is we take the number of shares we had outstanding at the beginning of the year, plus the number of shares we had outstanding at the end of the year, and then divide it by 2. And that gives us an average number of shares during the year. And again, we'll see price to earnings ratio in this chapter, which is going to be the market price per share of stock divided by its earnings per share. Okay, and one more, dividend yield. And this is the amount of dividends, the cash dividends a company pays per share divided by its market value. So it gives us a yield on the dividend. That's a lot of new information, I recognize. And I do apologize for going through it fast. I just wanted to be able to cover it within our meeting. And so let me look at, I see some things in the chat. Looks like, okay, Brad posted a link. That was, thank you, Brad, that was nice. And then other just discussion. So I know I went fast, and again, I apologize. What, is there questions I can answer, or are our brains full and we're about done?
Now, are we going to have to worry about recording things like Treasury stock? Because isn't Treasury stock recorded at a different, like, it's not always recorded at par value, it's recorded at what it was purchased back for? So are we going to
Yes.
have to like make those recording entries for
There-
things like Treasury stock?
Yes, there will be in this chapter.
Okay. Okay.
But also recognize on the upcoming exam, it should not, it just covers, let's make sure we know what chapters we're studying for. It should just cover, also it is 112, 2 and 11. So all of those. So yes. Yeah, so Treasury stock is just, we're buying back stock from the market in essence. And so typically when we buy it, we're debiting the Treasury stock account at cost, whatever we're paying for that stock, and then we're crediting cash. The other thing to recognize is that Treasury stock has a normal debit balance, which is opposite of other equity accounts. And so that means Treasury stock actually reduces the amount of stockholders' equity, because it's not, remember, the common stock account represents money paid in by the owners. So Treasury stock is no longer out there, for the owners. The exam, I don't remember off the top of my head. I could look that up for you, but I can't share my screen when I do. Let's see real quick. Whoops, it doesn't want me to minimize that. Hold on. $55 questions. Piece of cake.
This how many hours you give to us?
Yeah, so it gives you, policies. It is set to, I believe it is, 180 minutes, so 3 hours.
Cool. Thank you.
All right. Well, I don't know about you guys, but my brain is almost done. Any other questions before we finish up tonight?
I did have one question. I apologize if it's already in.
You don't have to apologize.
Can you use Excel in the exam?
Yes. That's good. In fact, I'll post that in an announcement to make sure everybody knows, because you're right. Every year I think people are like, it's not, I don't think it's clearly stated anywhere, but absolutely. It would be pretty dumb to teach accounting and not allow people to use Excel, which is like the standard industry tool that everybody uses. So yes. That's my professional opinion. Pretty dumb. Anyway, all right. Well, why don't we finish with a prayer? Any takers? Anybody who's like, I need some blessings right now.
I can pray for us.
Thanks, Katie.
Yep. Our dear, kind, and gracious Heavenly Father, we're thankful for this day. We're thankful for the opportunity we've had to meet together, and we're thankful for Brother Fox and the efforts that he puts into helping us learn. We pray that our minds will be clear, that we'll be able to absorb all this information, that we will be able to make sense of it, and that we will be able to feel proud of what we've learned, and that we'll be able to perform well on our quizzes and exams. Please bless us as we go throughout the rest of our evenings and with the rest of our responsibilities, that we will be blessed for the efforts that we are making to better ourselves and to improve our lives. We are thankful for all that we are blessed with, and we say these things in the name of thy Son, Jesus Christ. Amen.
Amen. Thank you very much. All right. Have a great night, everybody. And I will try to get those answers posted tonight after I have a class at 6 I have to teach. And then after that class, I can get to it. Thanks.
Thank you.
Yeah.
Thanks, Brother Fox.